Good morning, good evening, everyone. Welcome to the webinar on the topic of the risk management. My name is Hendra Lau, and you can call me Henry. I'm the Senior Technical Analyst at Elliott with Forex.com. How is everybody doing today? I hope that everybody is doing great. And can someone please let me know before I start if the audio and video is okay? Thank you very much, guys, for the confirmation. Okay, welcome again to the webinar on the risk management. This webinar is going to be about 30 minutes to 40 minutes depending, and I will also give some time at the end for any questions that you might have. You can ask me, okay? And let's take a look here, guys, with this webinar today. Thanks very much, guys, for the confirmation. Okay, so before we go into specifics, okay, about how to do the risk management in trading, I think let's spend a little bit time to understand, okay, what trading actually means and what a trader actually is, right? Because I think by understanding the definition of trading and a trader, I think from there you will get a new sort of insight into what you need to do as a trader, okay? And a lot of, especially when you are new to trading, usually people will be learning how to read the charts, how to use the indicator and so on. But most of the time they don't really learn specifically about the risk management. And like this slide here is saying, for you to be successful in trading, right, there are three elements. These three elements, you need to have it, all of them. You cannot have a good trading system that gives you an edge, which basically just means that it is a trading system, all right, that will be able to give you a higher probability of things going in your favor. That's what it means, a trading system that gives you an edge. But a trading system only that gives you an edge is not enough for you to be successful, right, in trading. Now, another very important thing is the risk management part. This cannot, a lot of people, most of them do not learn the risk management part, but they spend a lot of time trying to understand what an indicator actually means, how to draw a trend line, right? How to read the candlestick, for example. When new traders start to learn the basic about technical analysis, for example, and what an RSI actually means, right? And all those things. Those things are all good. And those things are the basic tools that you can use to build a trading system. But then on top of that, you need to have a robust and a solid risk management to be successful, because no matter how good a trading system is, it will never be perfect, right? And I think we all should accept that no trading system ever is going to be perfect. And therefore, losses here. So trading, therefore, is not about being right or wrong. It's not about an ego, right? It's not about an ego whether, okay, my forecast is right or my forecast is wrong. When we trade, we are different than when we forecast, right? When we trade, it's not about right or wrong, but it's about seeing the market in probabilities, right? So trading is the act of putting your hard-earned money in the market at the risk of losing it. Now, a lot of people don't like to hear this, but that's the truth. At the risk of losing the money every time you trade without fear. Why is it without fear? Because when you follow these three elements correctly, you should not have fear when it is time for you to take the trades, right? So it's the act of putting your hard-earned money in the market under circumstances where you have an edge, a higher chance or probability that price action will go in your favor while following strict risk and money management rules, right? So that's what trading is. So it's not about right or wrong, but it's about seeing the market in probabilities. We know that every trade we make has always has the risk of losses, right? The risk of being wrong. And therefore, when we approach trading that way, we need to be careful in terms of our position size. When we open a trade, we need to analyze it very carefully. What is our exit plan and so on, so that we can control the risk. Okay? And then second point here is trading is not a quick get rich scheme. Now, a lot of people who just trade who just begin to trade, they think that trading is easy, right? And it is easy to get rich and making a lot of return on your capital. It's nothing further from the truth, guys. It's nothing further from the truth. You can be lucky now and then, right? And but when you want to survive for a long run, right? Trading is not a quick get rich scheme. Okay, rather it is mastering. So this is the real definition. It is mastering the technique to preserve your capital. Okay, it is mastering the technique to preserve your capital. Just like in sports, they say defense wins championship, right? Defense wins championship. Whoever can defend well, they will win. So it's the same with trading. When you understand how to defend yourself when you trade, that's when you start to understand what trading is about, right? So when you learn how to manage the risk and preserve your capital, profit will come naturally. So you have to learn how to defend first before you learn how to make profit in trading, basically. And then a lot of times, though, people only will focus on making profit and not even thinking about how to defend themselves. And that's when people will end up losing, when they only focus on the profit when they trade. Okay, so that is this definition of the trading. Now let's take a look next what a trader is. What does it mean to be a trader, right? A trader is a risk manager. Your job, your main and primary job, is to protect your capital and manage the trading risk. That is your job. Your job, really, I mean, if you look at it this way, I think it will help you, because a lot of times, we trade and we focus on making a lot of money. But actually, our main job is to protect our capital and manage the risk every single trade that we make, right? Now, in trading, losses is part of the business and must be accepted as a cost of doing business. And this is really something that maybe it takes time for you to understand, but a lot of times people trade and they do not have the idea that losses is a common thing in trading. I can trade 10 times, guys, and I can lose 5 times. I can win 5 times, or I can even lose 6 or 7 times and I win 4 and 3 times and still be profitable at the end. Now, a lot of people do not understand that. Now, so therefore, in trading, losses is part of the business, must be accepted, because if you don't want to accept that you can lose in your trade, then actually you should not trade, because then you will be putting your trades without any risk management, right, without any stop loss and so on, because you never want to take losses. You think that, okay, we'll go back to your entry level, it will be going back in your favor, but it's not that way. If it's wrong, if it is wrong, you must accept it. And it's not about being right or wrong. Again, it's about having a trading system, following your trading system, and then if it is wrong, then you take it, right? You take the loss and you move on. So that's how it is. In trading, losses is part of the business. Just like any business always has 2 sides, revenues and the costs. And the cost will, I mean, there is no other business in the world where you can only have revenues but you don't have to incur any costs. That's just not realistic. Same thing with trading. So in trading, you will win some, you will lose some, the same. And at the end of the day, the most important thing is you can still make profit out of it despite winning some and losing some. Now again, if you do it right, sometimes you can even lose more than you win and you still end up profitable. Let's say if you take the losses quite often, but each losses is small, and then when you're correct and you stay in the trade and you make more profit, then you can be winning. In terms of the number, the quantity is less than the number of your losses, but then still can be profitable at the end of the day, right? And then the trading result cannot be measured in a series or trade. It has to be measured in a series of trades, not in trade by trade basis. So for example, just because you lose 1 or 2 times in a row doesn't mean you're going to lose 2 more times or 4 more times, right? Now again, you have to be making sure that the trading system that you have has an edge, first of all, right? If you believe that trading system has an edge, you need to repeat the same process within your trading system and do it over and over, and you will win some, you will lose some, but at the end of the day, when you follow the right risk management, it's going to end up profitable. And you have to believe in that process, right, basically. All right? Now, the risk management is always overlooked by new traders due to the unwillingness to take losses when they should have been taken, right? Now, how many times sometimes the best win is when you quickly get out of a losing position. How many times do you find that situation when you get out of a bad position quickly and then things actually get a lot worse afterwards, right? So sometimes the best win that you get is not really winning in terms of the money, but really getting out of a bad position very quickly because you notice something is wrong, you get out quickly, right? So risk management is overlooked because they do not want to take losses when they should have been taken, and because of always this hope that things will get better or positions go back to break even, but they never do, right? So the number one reason for failure of many retail traders is the poor risk management and inappropriate position size or over leveraging. So today we're going to look at exactly the steps to do this, the risk management, and also how to open the right position size and so on. Okay, but this is sort of to give you some introduction about what a trading is and also what a trader is. Okay, so what is a trading system? Now, a trading system, okay, when people talk about trading system, it's mostly using technical analysis. Now, there's also another, some people use fundamental analysis, right? They use the news, for example. So that's another part. But when we talk about a trading system, right, it has to be based on technical analysis. Because if you are basing your trades based on the news, you have no way to quantify or to limit your risk, for example, or to identify what is your profit target and things like that, right? In other words, you do not have any plan when you trade on the news. So when we're talking about trading system, it needs to have a complete components. For example, the trading system need to have specific rules. For example, it needs to have specific criteria where you can enter the market. For example, it's a limit order, right? So you put a limit order before the trade gets filled because you have a trading system that tells you that you can take that trade in that specific level, for example. And then the trading system also needs to have specific criteria where to get out when wrong. In other words, this is the stop loss, right? Also has specific criteria when to take your profit on the target profit. And then this is also important here. The trading system should provide at least 2 times reward from the risk taken. For example, if your stop loss, for example, is if you trade Forex, if your stop is 50 pips, then the target profit should be at least 2 times, 2 times more than 50 pips, should be at least 100 pips. So this is the specific criteria that is usually available in a trading system, right? And then an optional an optional criteria here is the system should provide a criteria when to create a risk-free trade. So this means how to protect yourself more. So let's say you enter the market, okay, and then you put your stop loss and everything, and then the market moves in your favor, right? It moves in your favor. Now you need to create a risk-free trade as soon as possible. How do you? Initially, you have a stop loss, right? Your stop loss should be your risk. Let's say you risk, let's say 2% of your capital with your stop loss. Now, how can you? As soon as possible, try to create a risk-free trade. And that system should allow you or should provide a criteria when you should move your stop loss, in other words. So that's optional. Some systems have it, some systems do not. Now in Elliott Wave Forecast, okay, because I come from the elliottwave-forecast.com, we have this system, we have our own system, trading system called, using the swing sequence. We call it 3-7-11 swing technique. And this system right here has everything here. It has specific criteria when to enter, specific criteria where to get out when wrong, when to take profit, and it always gives us at least 2 times reward from the risk taken. Also has criteria when to start moving the stop and creating a risk-free trade. So that's a complete system. What I call a complete system, regardless what kind of system you have. It doesn't have to be our system. Okay, you might have your own system. Some people trade, for example, using the harmonics, right? A lot of people trade using harmonic pattern, like butterfly and all those things. Any system that you use, whatever it is, it needs to have all these criteria, guys. And that system also needs to give you an edge. In other words, you should trust the system that when you take it, you will have a better chance, right? You will have a better chance to make the trade successful, right? And that is what we call a trading system. So a trading system should have all these components, and therefore it has to be based on technical analysis, right? And news should not be a factor in making any trading decision with technical analysis. So for example, today, Monday, there's a news about the from UK, coming out from UK over the weekend, right? And then the pound falls, right? Now people say, well, it's because of the news that the pound falls, but not really. Actually, in elliottwaveforecast.com, if you look at our chart of the day, we actually already forecast that it's going to fall. For example, you look, this is our website, and we have in the middle, we usually post chart of the day. We haven't really updated this chart of the day this week, but last week we have the pound US dollars, and you can see that we are forecasting it to the downside due to the patterns in the Elliott, using Elliott Wave. So in other words, when you use the technical, all right, when you use the technical, you should not be worried about what the news will or will not do. You should not be worried about that, because you follow the rules within the system, specific criteria when you can enter and so on. So it has nothing to do with the news, right? And you will just follow this formula here. If you're wrong, you're wrong, right? You move on, you take your losses, and you move on. So it's as simple as that. So news should not make you fearful and should not make you greedy either, right? Let's say, oh, it moves in my favor, and then now I'm adding my position. It's not that way, right? Because again, you only trade when specific things happen within the system here. So so first you need to have a trading system, guys. Before you implement, before you apply risk management, you need to have a trading system first, right? If you don't have it, you should try to learn one and stick to it and learn to use that system. until you are comfortable with it, until you think it is pretty good, and then you will use that system. Otherwise, when you do not use a system, guys, then you will have no way to control your risk in your trade, and you won't be able to really succeed in this profession. Okay, so it cannot be a random thing. It has to be specific rules. All right, let's take a look here. Some questions. Yes, all these rules is a must, Shane. Yeah, we use the swing sequence 3711. This is the technique we use. We actually use this every single time in our live trading room. We have a live trading room at 7 a.m. Eastern time, where we tell members, like we scan the market and see if there's any instrument within the Forex or commodities or the indices that fall into this criteria where we can trade. And then we explain why it falls into this criteria, and we have our own technique here using the 3711 swing. Now we are elliottwaveforecast.com. We provide the Elliott Wave forecast, but we always tell members that the Elliott Wave charts actually is not, it provides a path, a future path, right? It provides a future path, what we think that instrument is going to do, but that doesn't mean that the path that we are, let me show you this. For example, going back to this example, right? This is an Elliott Wave chart. Now you see that it's going to go up and then it's going to go down. Now that doesn't mean that, for example, people should buy this. It does not mean that this is something that you can trade or it is tradable. And sometimes this also doesn't mean that the move lower is tradable. So the charts actually do not really tell you exactly whether you should trade it or not. Now for that, you need to have a system. You need to have a system that can tell you, okay, I can trade, for example, this move lower, right? You need to have a system for that tells you exactly what will be the criteria when I look at the chart so I can trade it. And we use that technique we call the 3711 swing. Okay, and Shane was asking about now we in this seminar we are not going to talk about the technique that we have because it's about the risk management, Sandeep. But yeah, I mean we have a free trial. I mean if you want to try and you want to see, because we always also talk about the 3711 every single time anyway in our daily live session and the live trading rooms and so on, because I mean to talk about this is gonna take its own sort of webinar, right? The 3711. Now Shane has a question about the rules, right? The rules is a must, Shane. It is a must. If you do not have a system that has this rule, right, then you won't be able to quantify the risk, right? You won't be able to quantify the risk. So in fact, every trade that you make, you should plan it before. We always recommend members to use a trading journal. A trading journal should have all these criteria. You should always analyze the trade before you enter into it. It shouldn't be some kind of a like a reaction-based trading where you see news and then things move and then you enter without really doing proper analysis, for example. All right. Yeah, I can give you some some, like I said, you can use the 14 days trial, for example, for our service, but we do not have the webinar for the 3711 because we only use this for the members. Now again, you don't have to use 3711, right? Like I said, there are a couple of different systems out there, trading system. You can learn any one of them, but a complete trading system must have these components. That's what I'm saying, regardless what kind of system. You can use indicators, for example, right? let's say the rules is if, let's say if the RSI is overbought over 80 and something else happens, then you can trade, you can take the trade, and this is the exact way you trade it, you buy or you sell, and so on and so forth. So the system must have these rules in place, specific rules, right? And so that's the first thing, guys. When you want to trade, guys, remember you have to have a trading system first. Even when, let's say, our member, we always tell our members, you cannot use our Elliott Wave forecast and start trading everything there that you see on the chart without really understanding or knowing all these things here, right? You have to analyze it before you enter into the trades. Yes, Prasad, we'll be talking about that also next. Okay, guys, so far everything is clear, right? Now we talk about what trading means, what trader actually is, what a trader is, and we talk about trading system. We use the swing sequence, Feroz. Now Feroz has a very good question here. Let me copy that to everybody. In our 10 years experience or more, right, we find out that the best way to trade in the market is not to use indicators, but is to use the price action, So we use the swing sequence a lot in our own trading philosophy. Okay, but it doesn't mean that, I mean, we do not use indicators to trade, but that doesn't mean we are not trying to say like indicator is not useful or anything like that. But in our experience, we find out that trading, let's say a lot of people think that, okay, if you have a oversold RSI or overbought RSI, if it's overbought you can sell, if it's oversold you can buy. That doesn't work out, right? That doesn't work out. A lot of times indicators can be oversold for a long time, right? And again, without a clear rules, exactly when you get out and so on, you can get trapped, right? And so you have to have a system in place that helps you to with all these things here. Now, let's take a look here. What is the components of a solid risk management here? Number one, it should be, you should have a trading system which gives you an edge. In other words, like we explained earlier, it is a trading system that gives you a higher probability of getting things in your favor, right? It is a trading system with complete rules. Now, number two, the trade reward should at least be 2 times of the trade risk. For example, if you put stop loss 50 pips, if you trade Forex, then your reward should be at least 100 pips. Okay? So these components of a solid risk management. And then number three is a constant risk ratio. Now this is very important, guys. A lot of people do not understand this. It's a constant risk ratio. In other words, we always recommend each trade should be at most 2% maximum risk per trade. Each trade you take. Okay? So for example, if you use $10,000, for example, to trade, then each trade you take only has a risk of 2%. All right, so 2% will be $200, right? So if you lose $200 maximum. Now, if you like to hold multiple positions, let's say you hold 3 or 4 positions at the same time, it needs to be even less than 2, right? Let's say if you hold 3 positions, I would say you should trade like 1% or even less, because the idea is you don't want to expose too much risk for your equity in your portfolio. Okay, so our recommendation has always been, don't focus on just one pair when you trade, because let's say if you focus only trading the euro and euro only, now what happens is that sometimes the euro is in sideways move, right? Sideways consolidation, for example, and that kind of move is usually very difficult to trade. Now, if you only trade one and that pair or the instrument is not really trending, right? This means that you are going to have a lot of, a lot of difficulties if you only just trade one or two, right? And that's why we recommend that we believe that following as many markets as possible is the best way. In this way, you have choices. If, let's say, if the euro, for example, is sideways, but some other instrument is trending better, then you can trade the other instrument, right? So whatever fits that trading system, that fills that criteria, then you can trade it instead of only trading one. If you only trade one, most of the time is you won't find trading opportunities if the instrument is not really, trending, for example. Okay, so again, the constant risk ratio here is very important, guys, because let's say you decide yourself, okay, I'm going to risk only 1% per trade because I allow myself, maybe I'm going to hold more than one. I don't want to be stick to just one trade. Maybe I want to, to trade two or three at the same time. So I want to make sure then that my risk per trade is less than 2 if that's the case, because I want to, trade 3, for example. Let's say I decide that I'm going to only risk 1% per trade. Okay, so when I decide that, that means you decide your constant risk ratio. So this means that depending on your trading setup, okay, depending on your trading setup, your position size is always going to be different. It's always going to be different. Depending on your stop loss, your position size will always be different. Now, a lot of people think that it is a constant position size. For example, like, okay, if I have 10,000 US, I trade always 10,000 US as well. So meaning I don't use any leverage, but let's say I take 3 positions, and each time I open 10,000, then I'm using 3 times leverage because I'm using 30,000 basically for the 3 trades. But that's not what it means here. This means constant risk ratio is not the same as a constant size. The size always is going to change depending on where you enter and depending on your stop loss, right? And your entry level and your stop loss is going to be determined by your trading system. Your trading system is going to tell you, okay, you can enter here. Now, the trading system is not always going to give you, at least from our experience, our own trading system, the stop loss is not going to be like, oh, it's a constant stop loss, always 50 pips. It's not like that. The stop loss in the trading system that we have is always placed in a logical level, meaning that if that level is broken, then it changes the overall forecast, right? So that is a good stop loss. A good stop loss is not a random stop loss. It's a stop loss that is placed in a logical manner so that when that level is broken, you know that the forecast has changed. You know that the instrument has done something else. So that's a logical stop loss. So based on that stop loss, sometimes the stop loss could be 30 pips, sometimes could be 300 pips depending on the time frame, right? We are trading daily or for hour or 1 hour and so on. Depending on the stop loss, then we will adjust our position size every single time so that we stay within this constant risk ratio, which is 1% or 2%. All right? Yeah, so you can have 4 positions. So let me copy Shane's question. It's a good question. Which one is limiting your potential profit, Shane? Wouldn't... Now, the later one, you mean one single trade of 2%? We suggest that you actually take more than one because of the diversification, right? Diversification is important. So we do think that overall, I think it's better to take, let's say, 2 trades with 1% each. But I think the 2 trades must be uncorrelated. You know what I mean, right? So you cannot trade, let's say, SPX and the Dow, because pretty much they have the same oscillation. If one is, if one is going higher, the other one is going higher. So the two trades that you take, for example, has to be in a different group. For example, you take one index, let's say one in the Forex, let's say you trade the US dollar pairs. Then that's all right. Yeah, because the thing is, if you trade one with 2%, then if you're wrong, right? But then if you trade four, it's the diversification. The more you trade, because again, trading is not about always being right, like we say, right? There is always, you should think of trading this way, guys. When you enter, right? When you enter, you should always think, okay, my chance is only 50-50. You should think it that way. Now, if you think it that way, you will be a lot more careful before you enter into the trades, right? And my chance is only 50-50. So if my chance is 50-50, right, the only thing that is going to save you at the end of the day is what? Is this one. Your trade reward is 2 times of your trade risk, right? Let's say you take 2 trades, your chance is 50-50, you win 1, you lose 1. The one that you win 2 times of your risk, and your risk always the same. So let's say you risk 1% every trade, and you take 2 trades. You lose 1, you win 1. So the one that you lose 1%. The one that you win 2% because your reward is 2 times the risk. And at the end of the day, you make 1% profit, right? So that's why this is pretty important here. The trade reward, the system, the trading system that you have should give you at least, the reward should be at least 2 times of the trade risk here. Now, if you only trade one position, then you are kind of, okay, I'm putting all my eggs in this trade, right? What if this trade is not successful though, right? What if this trade is not successful? Now I can be taking 2 trades and one trade is 2% each, which means I'm risking 4%. Now every person will have a different risk tolerance, right? Some people will have more risk tolerance, some people do not have as much risk tolerance, and so on. But overall, the good practice is you want to limit it. You want to limit your risk to 2% maximum per trade. And if you want to take multiple positions, I would suggest no more than 5. 5 is absolute, ceiling. 5% is absolute ceiling, right? It really depends on your risk tolerance and also your capital and so on. But that's what I would be suggesting. Okay, and also the components of solid risk management is diversification, meaning that you should trade different groups of instrument here. All right. Martingale, we don't use that, Tim. Martingale is basically keep adding into position, like dollar cost averaging type of thing, or it's when you lose you double down. When you lose you double down. I think that's what Martingale is. We don't do that, right? So let's say you lose, let's say you open up a position of 10,000 US dollars position and you lose. Every time you lose, you double down. So you now open 20,000 and you lose again, you double down again, 40,000, something like that. Very dangerous. It's a very dangerous way to trade, and it does not really help you. It won't help you. Yeah, because they think that their belief is like this. You only need to win one time and then all your losses will be covered. That's what the martingale system is, right? So for example, your first trade is, let's say 10,000, you lose, right? Let's say you lose, I don't know, you lose 5%, let's say. So you lose $500, right? So you double down. Now your size is 20,000. The idea is if you win it will cover your previous loss as well as get some extra profit, small profit. So you want to profit, let's say 2% every single trade. So if the first bet is a loss, you bet again, you double down. If your second bet wins, your first bet is going to be your first loss is going to be covered, and then you also win that 2% profit that you are looking for. That's what margin call is. The problem with margin call is if you lose consecutive losses, let's say you lose like 5 times in a row, you can get wiped out. You can get wiped out, okay? So so that's the components of solid risk management, and then technique to create a risk-free trade. Now this one is how and when you can start moving your stop loss is also important, and to protect yourself more, right? And then finally it's a trading journal, okay? So that's the components of solid risk management. And then let's take a look now with this table here. This is equity loss and recovery. And so there's a reason, guys, why we want to limit our loss or our risk as low as possible in each trade. Now this is a table. On the left side, you can see this is the amount of equity loss that you have, okay? And on the right side is the amount of profit that you need to recover your equity to be to start, to go back to your initial balance. Okay, so let's say you start with $10,000, for example. If you lose 20%, right, because you trade poorly, you lose 20%, for example, you need 25% profit to go back to your $10,000, right? So 20% loss means you lose 2,000, so your balance now becomes 8,000. So you need 25% profit to go back to your initial balance, which is 10,000, which is still not too bad. Now you compare this, it's not really too bad. But you can see when it starts to get bigger, 30%, 40%, 50% loss, you see 50% loss of your equity means you have to win 100% just to go back to your initial equity, right? So the more you lose, the more difficult it is for you to recover. And that's why you should prevent this as much as possible. Let's say if you risk 10% per trade or even more, right? Now, if you just lose 2 trades, for example, and you lose 50%, it's going to be very difficult for you to recover from there. It's going to be a lot more difficult. But let's say if you just lose 3 times in a row, but let's say you risk 1% each time, right? You only lose 3%. It's easy for you to recover that. And every time you win, let's say your reward is 2 times your risk. So this means every time you win 2%. So in other words, you want to prevent this kind of big equity loss, because the higher you lose, the bigger your losses is, the much more difficult it is for you to recover, right? And that's why we want to limit our risk every single time. And this also, another part of it is it helps you not to get attached emotionally to your trade. Let's say if I always use the same constant risk, which is, let's say, 1%, right? What happens is that I will not be overly attached to my trade, right? It's different than, let's say, I do not put any stop loss, or I'm using like huge leverage. I'm using 20 times leverage. I will be like always looking at it. I will be always anxious, cannot sleep, and all those things. Now, those are things that we have to avoid as a trader. Those are things that we have to avoid, because in the long run, it's not going to be successful when we take that route. So we have to always stick to this risk management technique that we talk about. This is the components of a solid risk management system right here. Okay, and we're going to talk about more details about this. So let's take a look here. The steps. Now the steps. How do you do it? Number 1, you need to prepare a trade journal every single time. Now, first of all, you need to have a trading system, right? If you do not have it, you have to develop yourself, or you have to learn whatever existing trading system that that is available, right? But you have to prepare a trading journal and plan every trade with these components: limit order, stop, and target profit, right? And then number 2, you choose only one instrument per group for diversification purpose. We talked about it earlier. So for example, if I trade the yen pairs, let's say if I trade euro yen, I shouldn't trade the pound yen for my second trade, because that will be in the same trades. Okay, that will be in the same trade unless my first position is already risk-free, meaning I already moved my stop loss and protect myself, so even if I got stop out, I don't lose money. So unless my first position is already risk-free, I should not trade the same instrument. I should not trade instrument within the same group. Okay, so I should choose one in each group. For example, if I trade the yen pairs, I just choose one in the yen pairs. I choose, let's say, US dollar yen. I don't choose any other yen pairs, and then I can trade some other pairs. For example, I can trade the cross. I can trade, let's say, Euro Aussie or something else, right? But not the same yen pairs. So that's what it means. For diversification purpose, you want to only choose one instrument. Now, third step is after you know your limit order, limit entry, and your stop loss, then you know your risk in terms of the pips, right? Because let's say, okay, my limit order is to buy or to sell, let's say to buy the euro, for example, at 106, stop 105.50, then I know my risk is 50 pips, right? I know my risk. After I make the journal with this information, I can know my risk in terms of the pips. Then fourth part is you calculate the right position size by risking the same amount of equity. So this is the constant risk that we talked about earlier, constant risk ratio. So what you do is very simple. So your risk capital times percentage of risk is equal to dollar of risk. So in other words, let's say you have 10,000. 10,000 is your risk capital, and you decide yourself, okay, I'm going to risk 2%, for example. So you multiply 10,000 by 2%, you get $200, right? That's your risk. I only want to risk $200 for this trade. And then you know your stop loss. Your stop loss, let's say, is 50 pips. You can divide that $500, okay, sorry, $200 by the stop loss, right? So the stop loss 50 pips, you divide $200 by 50 pips, then you have your position size that that you can open for that. So for example, right here, if your equity is 20,000, you multiply by 2% is your intended risk, $400. Let's say you have 185 pips stop loss, then you can open 2 mini lots, right? So this will be the way you calculate your position size. Now again, your position size will always be different. Will always be different depending on your stop loss. Okay, so you cannot always open 2 mini lots every single time, right? That's not the right way. But depending on the stop loss, you calculate and then you determine the right position size. Now in our website, you can use our website here. We have a calculator there. You can use, you can do this calculation very easy. So let me show you where you can find it. If you go to our website here, it's elliottwave-forecast.com. Under educational here, now there's a position size calculator right here. So you can use this. It's a very easy, simple thing to do, and I will show you how to do it. But this is only for Forex. So far it's only for Forex. We're gonna maybe add futures, somewhere down the line, but for now it is for Forex. Now then the sixth part is only when the position is already risk-free, meaning you don't have any risk anymore because market already moves in your favor and you move your stop loss and so on, then you can open a new position with another 1 to 2% risk. In other words, you really want, like I said, the ceiling, the absolute ceiling is really 5%, but the lower the better. I mean, especially if you are still trying to learn, right? If you're still trying to learn trading, then the lower the better. And our recommendation has always been, even professional traders, professional hedge fund managers, they will not try to risk more than, usually they will just do 2% maximum as well, right? No, it's not just for beginners, it's also for professional as well. All right, now the lots is we have if you're trading Forex, depending on the they have the so-called standard account, and then mini account, and also macro account. Okay, lots mean too many lots. It just means that 2.16 means 2 mini lots. One mini lot is $10,000 quasi. Okay, so that's what it means. So you can open like $20,000 position for this trade. I will give you an example here. Okay, let's take a look as an example here. So you make a journal. Okay, like I said, first step is making a journal. Let's say, okay, you put the date. Let's say this is actually a real setup that we did in the live trading room. So in the live trading room, we always have a journal like this. Every single day we scan the market, and then last week on Friday we found out that, okay, this is trading idea, is in the crosses Euro Aussie, we can sell it short. This is our entry level, this is our stop level, this is our target level. Now based on this, right, based on this you can calculate the risk to reward, right, the risk to reward. And this is a 2.7 risk to reward, which is what we like, because we want to have more than 2 to 1 risk to reward. So trading journal was created with the setup above. Okay, and only Euro Aussie is selected in the crosses group for diversification. The reward is 2 times 2.7 of the risk based on the entry, stop loss, and target. Then based on the entry and stop loss, we can then calculate the stop loss in terms of the pips, right? Very easy. It's just simply 1.42, sorry, this is 429, 1.429 subtract with 1.4234, you get 56 pips stop loss, right, based on this. So then you go to elliottwave.com position size calculator, okay, and you enter this. So first you need to enter what is your account currency. Let's say your account currency is in US dollars. Okay, let's say you have a 10,000 US dollars account, and let's say you decide that you will only risk 1% per trade, right? And then you choose here, the currency pair is Euro Aussie, right? And then we calculate earlier, our stop loss is 56 pips, right? Based on the stop loss and the entry level is 56 pips. So you enter the stop loss here, 56 pips, and then you still need to enter the last thing here is the price for Aussie dollar, because you're trading in the cross. So sometimes they ask you the price of the components of the cross here. So in this case, it is asking you the price of the current price of the Aussie dollar US dollars. So you input the price of the Aussie dollar US dollars right now, which is 0.747, and then you click calculate, and it gives you how many you can trade. So this tells you, okay, with this amount, with this stop loss, you can open $23,900 position size to trade this trade here, shorting the Euro Aussie, so that if you are wrong, then you will lose 1% of your $10,000, which is, $100. Now you can, let's say if you want to risk more, 2%, then of course you can trade more position size, right? But then if you lose, you lose more. But then if you win, you win more, because again, remember, the risk to reward is 2.7, which means that if if your risk is 1%, if you win 2.7%. But if your risk is 2%, then if you win 5.4% because it's 2.7 times over your risk, right? So that's how you do the risk management. You calculate the position size based on the journal, based on the stop loss. Then you identify what is the position size that you can do for these specific trades. All right. So that's how we do the risk management and calculating the position size. Now I think we have ended the main sort of content of the risk management. Is there any question, guys? Let me show you a couple of things for further information here. Okay, we have in our educational site here, we have a lot more classes if anybody is interested. We have packages right here. Okay, this package here includes classes as well as one-on-one training. Okay, but if you only are interested in the classes, this is a value, it's a bundle package. You can look at the you can go to here and then click services. We have 4 different classes about trading and Elliott Wave. You can look around here if you want more information about Elliott Wave and trading in general. Okay, and if you are interested in getting the recording, today's recording, you can send me an email. I will give you my email. Hold on. Let me send you. Okay, so if you are interested to get the recording for today's webinar, you can send me an email. I can send it to you after it is finished processed. All right, guys. Thank you very much, guys, for joining. Yep, go ahead. If I have 4 positions of... Yeah, I would say, Shane, that the minimum is 2 to 1 because, again, think about it as each trade is kind of 50-50. If you think it that way, I think you will be more careful when you trade, right? And therefore, with a 2 to 1 reward versus the risk, then it gives you an ability, to recover very quickly, right? Because you don't want to take like 1-to-1 risk to reward ratio, for example, because there's nothing like just gambling, right? Okay, if I win, like winning and losing is the same reward to the risk, and that's why for us, we always take only trades that gives us. Now, the good thing about our system of the 3-7-11 swing is when implemented correctly, it always gives us at least 2 to 1, even more than that. So that's the beauty of it. Now, the good trading system, okay, with specific criteria and the rules and so on, can give you, without you having to come up with numbers and so on, always gives you specific levels and so on that automatically gives you a risk to reward of more than 2 to 1. Send me an email, Sandy, because I have a lot of people. So send me an email if you want anything so I can send it to you, all right? Because I cannot remember everybody here. Distribution system, I think because it's for members, Tim, and this seminar is really for everybody. So maybe, because I know you're a member, maybe you can ask it in the live session later on, okay? Yes, Roger, that's correct. I would say that you just need to follow your plan instead of, like, let me give you an example of this. This is the journal we make, right? This is based on the system that we have. It gives us this idea last Friday, and we took it, and now it's already risk-free because we sold it for 142.34, and now it's already 141.77 today, so it's already risk-free now. The stop is already moved to the entry level. But the idea is you just stick with your plan, and then you wait until your target is met. That's it. So just stick with the plan, whatever you have in the trading journal here. All right, so another question here. Yes, the swing sequence works for everything. Works for Forex, equities, futures, indices. Depending on the time frame for us, depending on the time frame, if you are trading higher time frame, the accuracy is going to be a lot higher, right? But let's say we always recommend for hour, right? For hour, if the condition is good, it could be 70 to 80%. At least it gives you the beauty of our system. The 3-7-11 swing sequence is, even if we are wrong, right? Even if we are wrong, we are able to have a risk-free trade. So in other words, the system allows you to get risk-free even when you are eventually wrong. So that's the beauty of our system. So when we are wrong, most of the time we are break even, because we can get risk-free, move our stop loss, and then waiting to see if the market can hit our target or not. How long? That's a good question. I think it starts with the computer, Matthew. After the after the algos coming into the market and the computer system, people trading with computers, market starts to move more in a 3 waves nowadays. 0.747. Where's that 0.747? Quasi? Yes. Yes. I'm not sure what your question is, Dre. You can open a micro account, but it really all depends on this, Finn. It doesn't matter how much equity you have, but the question is, let's say if you use $1,000, right, equity. Now, for you to risk 2%, that's $20, right? Is it possible? The question is it possible to open a position size, so that you only lose, like $20? I mean, it doesn't really matter what your equity size is. You follow the same, whether you're $1 million, $100,000, $10,000, $1,000. It doesn't matter. You use this setup, and then you make sure you only risk the 2%, and then you use the calculator here. And you can use the micro to learn until you understand, right? I think it's always a good idea to learn first, right? You go to, so it's the same technique. You use the calculator here. You just need to put in your account balance 1,000. Now your risk is 1%. Let's say you trade the Euro Aussie earlier, right? And if you put down, for example, now stop loss 56 pips, right? And then the price for Aussie dollars is 74.70. Now it tells you can open only 2 micro lots. So yeah, it's still doable. You can open up 2 micro lots, right? I mean, it's good for you to do this, to learn. I think it's a good idea sometimes to trade with real money to practice, but using micro account until you understand how it works. Sometimes with demo account, you seem to not care whether you win or you lose, so you feel like easier to do it. But then when you use a real money, it gets more difficult, because then you have you have emotion attached to it. All right, guys. Thank you very much, guys, for joining, guys. And for those that send me an email, I will send you the recording after it is finished. Have a good day, everybody, and see you guys again next time. Bye, everyone.